Hi guys, and welcome back to Economic Street. I'm Ola.
And I'm Nicholas.
And today we're going to be carrying on the conversation on investing. And we're looking at one particular aspect today known as mutual funds. Now, last time, Nicholas, we spoke about getting onto the stock market.
Correct, yeah.
Whereby people can look to buy shares in companies.
Yeah.
However, mutual funds actually makes it easier to get access onto the stock market, doesn't it?
Yeah, so what essentially a mutual fund is, it's a pool of assets. So, for example, me, you, and other investors could put our money together to then invest that money into a pool of securities. Well, when I mean a pool of securities, so shares, bonds, government bonds, so money market products. So what that is essentially diversifying your portfolio, because what you're essentially doing, you're investing a lump sum of money but into different asset classes.
Okay.
So instead of having all your money in shares, your money is split across and spread. So that's known as diversifying your portfolio.
Okay. Let's break that down. So we've got, first of all, you said it's people coming together to put money into this pooled asset.
Correct.
But we actually don't have to know each other because it's all kind
That's
of
correct.
right now. So it's literally
it's changed because then,
as
we spoke about in our previous about getting onto the stock market, if you get in touch with a broker, brokers actually have
mutual funds
listed on
their platform.
Correct. So as I said, the days of actually you physically going around to all your friends, you can actually
do it online now.
Correct, through your broker.
And they literally, so some of these funds are billions. They're worth
correct.
Billions.
There's different sizes.
Yeah, but essentially, think about it this way: it's like having a cake, and everybody gets a slice of that cake. The assets in this cake are the ingredients that you've used, so the milk, the butter, the sugar, whatever else goes into that. Those represent the assets. So those represents the shares in Vodafone or Tesco's,
correct.
Apple. They can also represent bonds, government bonds.
Correct.
So bonds are whereby a government has gone to borrow money from people essentially, and that bond they pay you an interest. So bonds also represent an asset, and it can also include these assets. These ingredients can include other things like property.
Correct.
So another sort of
they're more exotic type of mutual funds.
Okay.
But your standard mutual fund will be typically made up of shares, government bonds, and corporate bonds. They're what you call your standard mutual funds. So say the advantages of having a mutual fund is that they give people with
low money.
So if you haven't got a lot of capital, so not a lot of money, it gives you a chance of getting started to make income for yourself in the future. Yeah. Because mutual fund is pulled from all other people, and as in now you get it online where there's mutual funds already set up. You're just putting in a small amount
and getting like a very small slice. So it might be a small slice. So rather than owning one share in Apple, which can cost hundreds.
Correct.
Because you put your money together with other people, maybe you have like 1/100th of a share in Apple. Correct. But at the end of the day, it's giving you access to being able to invest. And I like what you said. It's all about diversifying your portfolio. Yeah. Can you just explain what the benefits of a diversified portfolio is?
So diversifying your portfolio is where you don't have assets all of one class. Or not just one class, but in terms of the same type. So because you can have different classes of equities, for example. But
different equities meaning shares.
Yes. So when I mean by diversifying, so you've got shares, bonds, and then even with bonds, you have government and corporate bonds. You have a mixture. So for example, if your shares fall, but the government bond might be rising, they then balance out each other. That's what you want. You want to have a portfolio where they have a negative correlation. Okay. And what I mean by negative correlation is when one goes one way, the other one goes the opposite way.
It kind of
nets off.
So it's basically a way of reducing your risk.
Correct.
Especially if you're risk averse.
Yes, because as I said, if you got everything just in shares, or just say just the one share,
let it ride.
Yeah. And then that share collapses. Yeah. You're then stuck because your risk is all on that one share.
Okay.